Loans. We see them everywhere, right? From buying a house to starting a business, sometimes you just need a little or a lot of extra cash to make it happen. Loans can open doors to big opportunities, but they can also feel intimidating. In this video, we'll break down how loans work, the main types and tips to use them wisely, all in just 5 minutes. Okay, let's start with the basics. What exactly is a loan? In simple terms, it's borrowed money. You're essentially renting money from a lender, whether it's a bank, credit union, or even the government. But like renting that sweet apartment downtown, borrowing money comes with a price, and that price is called interest. Think of interest as the lender's fee for letting you use their money. Let's say you take out a $1,000 loan with a 5% interest rate. That 5% doesn't sound like much, right? But over the life of the loan, that 5% adds up. By the time you've fully repaid the loan, you'll have paid back not just the original $1,000, but an extra $50 in interest. That brings your total repayment to $1,050. Now, interest rates can be fixed or variable. A fixed interest rate is like your reliable best friend. It stays the same throughout your loan term. This makes budgeting predictable because you know exactly what you'll pay each month. Variable interest rates, on the other hand, they're more like that friend who's always full of surprises, not always the good kind. Variable rates can fluctuate over time, meaning your monthly payments can go up, or sometimes down. This can make budgeting a bit trickier, but variable rate loans sometimes start with lower interest rates than fixed rate loans, so they can be tempting. Understanding how interest works is key to being a savvy borrower. Now let's dive into the different types of loans you might encounter. First up, we've got secured loans. These loans require something called collateral. Collateral is basically an asset you own that you promise to give the lender if you can't repay the loan. Think of it like a safety net for the lender. One of the most common examples of a secured loan is a mortgage. When you take out a mortgage to buy a house, the house itself acts as collateral. If you stop making payments, the lender can foreclose on the house, meaning they take ownership and can sell it to recoup their losses. Another example is an auto loan, where the car you buy with the loan serves as collateral. Next, we have unsecured loans. These loans don't require collateral, but here's the trade-off. They often come with higher interest rates. Why? Because the lender is taking on more risk. A common example of an unsecured loan is a personal loan. People use personal loans for various reasons, like consolidating debt, funding a home renovation project, or covering unexpected expenses. Another type of unsecured loan is a credit card. Credit cards are revolving credit lines, meaning you can borrow up to a certain limit and make monthly payments. They can be super convenient, but they often have high interest rates, so it's crucial to use them responsibly and pay your balance in full and on time whenever possible. Chapter 3. Tips for using loans wisely. Loans can be powerful tools, if used responsibly. Here are a few tips to make sure you're borrowing wisely. First and foremost, before you even think about taking out a loan, ask yourself, do I really need this? Loans should be used for things that will improve your financial well-being in the long run, like investing in your education or buying a home. Don't fall into the trap of using loans for frivolous purchases you can't truly afford. Once you've determined that a loan is necessary, it's time to talk numbers. Can you comfortably afford the monthly payments? Remember, taking on a loan means adding a new expense to your budget. Make sure you factor in all your other expenses like rent, utilities, groceries, and transportation to ensure you can comfortably handle the added loan payment without stressing your finances. Here's a big one. Don't just accept the first loan offer you receive. Shop around and compare interest rates and loan terms from different lenders. Even a small difference in interest rates can save you thousands of dollars over the life of the loan. Trust me, a little bit of comparison shopping can go a long way. And finally, once you have a loan, try to pay more than the minimum payment whenever possible. Why? Because making larger payments reduces the principal balance faster, which means you'll pay less in interest overall. It's like a fast track to becoming debt-free. There you have it. Loans explained in a nutshell. Remember, loans aren't inherently good or bad, they're simply tools. Loans can be incredibly helpful for achieving your financial goals, but it's crucial to use them responsibly and strategically. Loans are tools, not traps, if used wisely. Subscribe for more tips on managing money and making smart financial choices.